Shift gears and talk a little bit about what's playing out here in terms of some of the activity in financial markets. We've got just the person to help us with that. Bill Baruch joins us. The president of Blue Line Futures is here with us this Tuesday morning. Bill, welcome. I was just looking at the move lower yesterday in reaction to Powell's shift in tone from his comments last week. What changed?
Well, I think it's a Jekyll and Hyde narrative, and that's how we talk about it. We've been talking about it for a couple of years now. You get one face during the meeting and the policy statement, and then you start hearing something a little different thereafter. And in this case, it's less hawkish. Kind of just get that lift off, let the market digest it, and make that within the official statement. Now, he wasn't really less hawkish during the policy statement. It was nothing new, nothing surprising, and they did a really good job in delivering that policy statement in that press conference. Now it's time for them to be a little more hawkish, and that's what we saw from Fed Chair Powell yesterday. It's what we heard from the two hawks, Bullard and Waller, on Friday, with no surprise. But one thing I was looking back and trying to see where the market, overall found good footing through his comments yesterday, and yeah, he's shocked a bit with the expeditiously moving on rates. However, a little later on in his discussion, he talked about the balance sheet runoff starting next month and how it could last 3 years. I think that is something to look at, where that comes off maybe an elongated timeline, and it doesn't seem as hawkish, where they're double tightening, if you will, in the next few months, next few meetings, and really speeding up that balance sheet runoff. So that's something to keep a pulse on.
Hey, Bill, we're looking at the treasuries right now, and the bonds, the 10-year, taking a note of what we've been seeing in the shorter end for the most part over the last few weeks. It's really starting to participate here along with what we've seen, the ZF and the ZT, for example. But, I was wondering, how much of this do you think is tied to the recent run-up we've seen in crude oil up to 130? I'm not sure if that was really a factor or consideration a week or 2 weeks even ago.
Yeah, I think there is some tailwinds with the inflation narrative just in general that are pushing rates right now. Absolutely. And the move in crude yesterday was a huge one, and it definitely brought an additional tailwind to the Treasury space, to rates. Now, another thing to think about here as we head into quarter end and looking at the equities, I mean, we've been bullish, overall, through this buy the invasion narrative. And one thing to digest here is the quarter end. I think there's a gravitational repositioning in equities, where the managers, they're really in a situation where they're not going to sell. I mean, they have underperformed. They're looking to catch up to the benchmarks, or catch up to for clients to see a better positioning, a better performance. And it's a situation where no one's really necessarily looking to sell unless there's a reason, or if the thing starts snowballing a bit. Similarly, looking at the rate landscape, especially in short duration, these managers are likely not to look to have excess bond exposure in portfolios and then really kind of add it to the equities. Not necessarily a broad rebalancing, but with people with loose mandates, and then they can look at these bonds as saying, okay, we're selling our bonds, and they're not going to be in the statement, so no one's going to actually necessarily see that, and then they're doubling down on, okay, we love our stocks. So I think there's some excess selling across the bond space here through quarter end, and that could likely bring a bottom in the next 2 weeks in the treasuries.
A lot of talk about the yield curve flattening, in some instances inverting. Bill, how much attention are you giving this one?
Well, the 210, it did hit a new low last night, I think about 15 basis points on the spread, and it's sort of falling precipitously. And one thing to keep keep in your mind too is the 3-month against the 10-year has actually steepened quite a bit in the last 2 weeks, and that's something that maybe the Fed's looking at a little closer, and that says to them that, okay, although some of the short end of the curve, the 210, the the 530, they're all really flattening out pretty heavily, but the 3-month and the 10-year gives them a little light at the end of the tunnel for this time.
Talk to me about what this means for the U.S. dollar. It seems to be holding below that 99 handle, supported by some of the comments from Fed Chair Jerome Powell, but unable to really lift off and, again, add to some of the gains that we've seen throughout the beginning of the year.
Yeah, the dollar's holding up pretty good. It definitely responded to his comments yesterday, really focusing on the rate moves in the coming meetings. And I mean, there's overall a lot of resistance in 99, in the dollar index, and right around 98. It's just been battling at. So, I do believe the narrative that the dollar likes to top at the onset, early stages of a hiking cycle. I think this added war inflation is something that has kept if we look back at December and January and February and how hawkish the Fed was. And the market had priced it in pretty quickly, and they were really set on a path to become less hawkish. And that would have been sort of a normalization into the liftoff and thereafter. But this extra war inflation, you have tailwinds in the U.S. dollar as a safe haven, and then you also have, like we've seen with crude oil, added inflationary tailwinds that are going to have to maybe force the Fed's hand a little bit quicker than initially anticipated.
Quick look here at, you can see some of the other markets, again, that we oftentimes tie to the U.S. dollar in terms of commodities, but I want to just look at rates alongside. Well, I've got them laid on top of each other here. In this instance, the TNX is the candles higher. Well, if this week, 3 weeks in a row, 4 out of the last 5, and a solid run up here as we've breached that 2% level. We're holding above it convincingly. You can see the U.S. dollar in the purple line here. It's been relatively elevated as well, as we just pointed out on the daily time frame. Let's talk about some of the other foreign currencies, Bill. I've got my eye on the euro. I've been watching the yen, which has been in just a free fall amidst some of the unease there. You've got a highly supportive environment relative to what we've seen, and we were just talking about in terms of the Fed and that shift to a bit more of a dovish or a hawkish tone here in the U.S. But ultimately, I mean, it really speaks to the narrative in terms of the different circumstances that they're dealing with, but also, again, really just the technicals in terms of the yen as the trajectory to the downside has been noteworthy.
Yeah, I mean, it's definitely been a trend, so that's something that's continuing to press it. But the clear divergence between every other major central bank and what we're seeing from the Bank of Japan, and that's something that no one really wants to fight at this point. And I mean, typically too, as rates go higher, it presses money back into the U.S., so that's also something weighing on the yen. Yeah, the number of factors, but that clear divergence between policy in Japan relative to other major central banks in other major countries is going to be something that they're creating this positioning tailwind.
Japan actually lifting some of their COVID restrictions in Tokyo. I'm reading some of the outlying areas. But again, you can see here down 1% again here. How about the euro currency, Bill? It's been holding lower levels here against the dollar weak, as again, you've seen a situation where the ECB is kind of unwilling to get on board in terms of what we've seen, whether we talk about the Bank of England recently raising rates, again, the third time in as many meetings. You ultimately have the Fed here now suggesting potentially for 50 basis points if need be. I mean, it does seem like it's time for the ECB to get on board.
And they likely will. Obviously, there was a bit more hawkishness expected from them in the most recent meeting, but that was delayed due to the conflict, the war in Russia, Ukraine, and what could potentially be the aftermath. I think once they work through that, they're going to know the inflation tailwinds that are going to be there. They're going to have to probably move a little more quickly, or at least purchase less purchases, and they continue to dial back those purchases. Maybe elongate the purchase timeline, just to kind of keep a cushion for how the market might react with a less dovish or more hawkish narrative. So, I think too, same thing with the dollar. You have these safe haven tailwinds in the dollar. You have selling in the euro due to the conflict, but I think people are really hesitant to get too far ahead of themselves to how low the euro could go, because you're going to have to see that shift back from the ECB at some point this year. And then remember, if the dollar does top or at the onset early stages of a hiking cycle, no one really wants to be selling the lows in the euro.
How low the euro could go. It sounds almost like a boy band from the 90s tune or something. Bill, we're looking at the euro currency here right now, and we're talking about double tops here around 115 from the beginning of the year in February, and then the sell-off came down to 108. We've kind of been recovering since. I just want to remind our viewers, when we're talking about the U.S. dollar, I have it here on the left, almost a mirror image from what we're talking about here in terms of the 6E, the euro currency, as it's, again, 75-ish, whatever percent of that basket of currencies that makes up the euro, the dollar, that is, the euro euro being, again, a big part of that. So you'd expect to see that inverse correlation. We'll continue to watch those relationships with some of the currencies and the reflection that they are in terms of some of the comments from Fed Chair Jerome Powell and the central bankers globally, I guess, for that matter. Bill, appreciate you joining us to talk financial markets this morning. Bill Baruch, the president of Blue Line Futures.